Hi, this is Dustin with Dustin's Dollars. Today I'm going to be going through the Knightscope 2024 Q2 results. Going to talk a little about the state of the company, and yeah, that's the agenda for today. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Knightscope, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So I'm going to sort of briefly, as I mentioned, walk through some of the Q2 numbers. I'm not going to go super deep, and I'll explain why in just a moment. And then I have sort of a forward-looking projection model that looks at, sort of what could happen realistically with the company, I think, in the future. So going through the important numbers here, their revenue, ticked up quarter over quarter, but was down, I think, year over year. And they explained that basically, they had a large product sale on the K1B side of the business a year ago, and so they didn't have that this quarter. The piece that I really care about, and I mean, I mentioned this on the channel many times. Sorry, I should pause just for a moment. If you're not familiar with Knightscope, they have two sides of the business. One is emergency communication devices. These are like emergency phones, blue light towers with phones on them, those sorts of things. And then the other side of the business is the more, exciting side, which is the autonomous security robots side of the business. Those are, the security robots that go around, and that's, what the company was before 2023, mostly, and then they acquired another business that brought on the entire emergency communication devices portion. But so I have another chart here that is just looking at the ASR, that's the autonomous security robot revenue per quarter, and you can see this has been, let's say, relatively flat for quite a while, right? Since middle of 2022, and one could even say back to in around 2021, that it really hasn't moved very much. And so that's been still disappointing to see that this didn't tick up, even as they started to improve their manufacturing capabilities and the ability to actually deploy at a faster rate in Q1 and Q2. They did explain a lot of this, and this was the version 3 of their flagship product, the K5 autonomous security robot. That's the one that looks a little bit like R2D2. That is, I think, comprises the majority of their autonomous security robot revenue. They had the version 3 of this robot that had been previously deployed. Version 4 was sort of a failure and never got deployed in any meaningful volumes. And now they are starting to see the limitations of even that version 3 product, and they're replacing them at existing customers with the version 5s. And so because of that, I think they were shipping more out the door, definitely in Q1, even in Q2, and not seeing any new revenue, right? Because they're shipping these out to clients that already had a robot. So they're taking away the version 3 robot, scrapping it, taking those parts and reusing whatever they can, and then replacing it with a version 5 robot that is actually working. And that is that's why we didn't see I think a large tick up here. I believe there may have been some in the quarter that were new clients, but we just probably, it's possible that they shipped some of those in the last month, or even just the last half of the quarter, and didn't really yet have them deployed and running at those new client sites, because I think there's still a lag time between when the robots are manufactured and shipped out. Obviously shipping takes some time, and I think there's some work that a Knightscope technician has to actually do, or someone that's maybe it's a third party, and maybe they can do this with Konica Minolta, I'm not sure, but somebody has to actually go there to the site and do a little bit of prep work before the robot can start operating, I think, on behalf of Knightscope. And so I think there's even this additional lag time where the robot will not be bringing any new revenue immediately. Hopefully they can get this time down to, a couple of weeks. Eventually, hopefully they can just have the robot ship and let the client be able to do the prep work themselves. But I think that's a bit away. Hi, Transient Stacker. Thanks for hopping on the stream. But anyways, so the revenue has been flat, and I think that explains why we see this despite some improving fundamentals behind the scenes of the business. And if we go down and we look at some other aspects of the business here, their margins, I think I took out the chart on margins, didn't get to put it back in, so I apologize, but I can go back up here and look at my raw numbers. So their margins have been really bad. over time. And I have this is their service gross margin, this row right here. And Transient Stacker asks, how about Rocket Lab next? Sure, absolutely. I'd be happy to cover Rocket Lab. There's actually quite a bit of other folks to talk about on YouTube. There's even a weekly show, Rocket Lab Weekly, if you want to look that up. There's some other folks that I myself watch that, when I'm able to. So there's a fair bit of folks talk about that. But I would be happy to go through some updated, give an updated view on Rocket Lab. I think the company is doing, they're on the right path as they have been. I think the stock is starting to move in, as a recognition of that. But, so yeah, I can do a video on Rocket Lab next. I will absolutely take that into account. So anyways, continuing on with Knightscope here, what I was mentioning is their service gross margins are actually, they've been bad. And so this is the cost of their service revenue versus their actual service revenue that they bring in. And, historically these have been negative, even in terms of gross margins, right? So they're losing money even at the top line, or at the, before we even consider all the R&D, G&A expenses, etc. Before the Case acquisition, this was trending somewhere on the negative 50 to negative 80% range. So really, on paper, pretty bad. A lot of the reason why this is negative, at least as explained by the company, it makes sense to me, is because they're just not at scale yet, right? There's a lot of fixed costs in here where they need a certain team of people to actually monitor some aspects of the robots. And they have a certain team of people, again, to deploy the robots. And if you don't have a large base of robots already deployed and operating, in comparison, the cost of those folks is pretty high relative to the revenue they bring in. But those are not going to scale. Those costs are going to be more like fixed costs, because they're not going to scale up with the number of robots that they have to deploy. With the size of the fleet of the robots, I should say. So if they go a year from now, they're able to deploy a bunch of stuff, and now they have double the amount of robots, and another year after that, they have, again, double the amount of robots. Some of those costs are not going to come close to, quadrupling, even though the revenue from the robots will. So that's a large, that's the elevator pitch on why the margins look so bad, and why this is still a company you might be interested in investing in, and why it has caught my attention. And I'll be the first one to admit that I was hoping these margins would improve quicker than they have. But if we look at this in the the second quarter of 2024, the margins were, at face value, negative 43%. So that's pretty bad. One thing that I would note is they have some costs included in this that are related to that replacing those version 3 robots that were out there in the field, and in particular some just costs of scrapping those robots, right? The cost of replacing them and then scrapping them and writing off some of the inventory. And some of this is actually accounted for in that service cost of revenue that they have. And so if you look at this, I can actually net out a little bit. In Q1, you can net out $800,000, and in Q2, you can net out $300,000. And so their adjusted margins actually look like they're getting, marginally better, right? Again, these are still very bad, right? Gross margins of negative 27%, 28% really, if you round it. That's still bad. But we do see the very first signs of their margins improving. And now it's hard to say that these are actually from the version 5 K5s versus, maybe they're able to get some better margins out of the service, the maintenance contracts on their emergency communication devices. We don't know. We don't have that level of visibility here, but it's something that quarter over quarter, as another 1, 2, 3 quarters worth of data comes out, it should be very apparent, right? Because I just don't think there's the level of growth that we're going to see on the emergency communication devices side of the business that we're going to see or that we could see on the ASR side of the business. So because of that, I think it will be more clear to tell what the margins actually look like over time, once we get a little bit more data. But again, this could be the first inkling where actually the margins are improving. So just take that into account. Again, we really don't know, but it's, I think, something to note. All right, now if I go back down here, you know what? I'm going to skip the other chart because that kind of is the overarching point here. Well, you know what? I'll look at one more. Let me take that back. And the one more that I'm going to look at is their operating expenses. I'm not going to go through some of those because I don't think they're as meaningful right now. This is our operating expenses per quarter. The yellow is a sales and marketing, the red is a G&A, and the blue is the R&D, and those are actually stacked on each quarter. So you can see that the top line there, which is the yellow one, where those points lie actually represent their total, operating expenses, and then the area of each of those is really how much each one was. And so you can see the R&D spend here has not really grown. It's actually at a lower level than it was throughout 2022. They did some restructuring in the first quarter of 2023, which dropped it quite a bit, and it has not really, it's grown a bit since then, but it's not actually a major driver of growth for their operating expenses. You do see that the G&A costs here are pretty large, and I think a lot of that came around just from being a public company, having a lot of overhead there. Again, as the company is mentioned, and as I mentioned before, this is another thing that you would think about as more of like a fixed cost, something that hopefully shouldn't grow with the with the revenue, right, with the top line. So that, cross your fingers that doesn't grow too much. Again, you do also have some things to look at there in terms of executive compensation, but it's wavered a little bit. And then you also look at the sales and marketing. And this one is one that has been, if you look at the area, pretty flat. And I guess we can go up here and look at the numbers and actually see this. But sales and marketing hasn't really, it's been in this range. If we go down here, sorry, I have way too much data on this company here. Sales and marketing, you can see this is $1.5 million range for the past year. There was this dip down where it was in the lower range, but then it was back up in the mid $1.5 million per quarter range since the middle of 2022. So for about 2 years, that's been where it's at. I think they spend a good chunk of this on advertising to investors, which hopefully they are going to be done with very soon. That's a pretty easy way to just cut this down. Although on the flip side, I have to assume they're getting a decent return on that, given that they are actually, raising money through their at-the-market facility that they have, at the market. I said it the right way this time. That's how they're raising cash for the company. I'm not talking the cash flows in just a moment, but the point that I want to make there is, their sales and marketing hasn't been growing massively. It's been relatively flat, and I think if they reduce the spend on, advertisements to investors, as I've been seeing, and again, I have no idea how much of this portion that represents, that is another way that they could actually sort of reduce some of the costs, and maybe they could invest that instead in more sales and marketing for the actual business itself rather than the stock. So that's something that I'm, again, hoping to see. I'm hoping to see an end to those ads that I see for the stock. But anyways, that I think is a pretty decent overview of the general income statement of the company. If we want to go look real quick at the actual balance sheet, just so you know where they're at there, they have, if I can scroll down to it, hopefully this isn't too small, about $2.6 billion, sorry, $2.6 million, not billions, $1 million of cash, all on balance sheet. They do have the debt right now in the quarter that was from the public safety infrastructure bonds that they raised at the end of last year and beginning of this year, and those they won't have to pay back for another, I want to say it's 5 years, so they're not due anytime soon. They are paying interest on that. If you go up here and you look, not up, down, look on the statement of operations, you can see in these quarters the interest expense is starting to get significant. It's about $128,000, and I guess that probably should show up in the cash flow statement as well, maybe. No, I think it usually would come down here where they can disclose it if they want. They're not required to, but yeah. So it looks like they paid somewhere around $100,000 of interest. I didn't dig into the details there. I'm just reading it right here off the statement of operations. So there could be other things in there, but I think that's the gist of it. Now I will note, and hopefully I have the 8K open here. They did actually do an additional deal with some folks who previously held some warrants with the company and had some extra provisions on those. This is apparently with Alto Opportunity Master Fund SPC, whatever that is, some financier. So they made a deal with them back in 2022, and then Knightscope now made an updated deal with them. This is after the end of the quarter, so it was on August 1st of this year, to basically get rid of those warrants and some of the provisions that went with them. And I'm not going to go into details here, and this is where I'm actually going to even go back and say at the very beginning, I said I'm not a financial professional. This is fairly complicated to understand the details here in terms of why this ends up being a good thing for Knightscope. So this is another thing you kind of have to trust management on. But basically, they got rid of these warrants, but in exchange, Knightscope is going to pay them. They're just going to pay them the cash right now in terms of, well, it's not right now, it's over the next year, roughly. They're paying them $3 million, right? So they took this on effectively as debt. They did not receive money from it, but they are paying $3 million back to this fund in exchange for those warrants going away. And so basically the company explained this on their most recent Q&A. I'm not going to call it an earnings call, but it's effectively their version of an earnings call that they did after the Q2 results came out. And this is presumably opening up options for Knightscope to be able to get financing in other ways, right? Because as they explained it, there were some pretty nasty provisions in these particular warrants that gave this company rights to participate in future offerings, and there was some other stuff in there that, as they explained, it basically let this company just short them as much as they wanted and have it be basically free money, because they knew that they were going to be able to buy in the future shares from the company at whatever price they would be issuing in the future, which is presumably lower after you're shorting the stock. So anyways, that is, and then they had these warrants as a backstop, right? Because at the very least, they'd be able to exercise the warrants at a particular price. So it gets a little complicated, and I won't even say that I understand all of it. But the point was, Knightscope now has even additional $3 million of basically debt that was not reflected on the end of Q2 balance sheet up here in order to extinguish those warrants. So that is where they're looking in terms of balance sheet. Now, in terms of cash flows, they continue to be negative, and they report like most companies do, and they have the cash flows for the 6 months ended June 30th. I think I have an actual cash flow progress. Before I go to the cash flows, let me just real quickly talk about two things, because I'm going to spend most of my time on the cash flows today, or at least a good chunk of time, because I have a projection model. A couple other notes came out from this report. You can see that their sales backlog actually dropped in the quarter pretty significantly. So this is what it looks like, and you see that very last point there, the very last dot is the last quarter, or the most recent quarter, right, Q2 of 2024. You can see that backlog has been roughly, around or above $2 million for every quarter until just this quarter. And so to me, that means one of two things, right? Either a lot of folks canceled, or, and hopefully this is the more optimistic state, which makes sense to me, Knightscope was able to deliver a good chunk of robots, and so now they have actually reduced that backlog down. And it's possible that some of these robots were delivered late in the quarter. Again, as I mentioned up front or early in the video, that we didn't really see the full quarter's worth of revenue from them. In some cases, we may have only seen 1, 2, 3, 4 weeks of revenue. So a very small portion compared to the overall quarter and what we might see next quarter from those. But because this backlog has been dropping, if you want to be semi-optimistic and think that that is actually the company deploying robots, then this is actually a good thing, because there are now more robots at customer sites and not just a signed contract but nothing physical backing it. So that is potentially a good thing to see. It would be a bad thing if the backlog dropped because some folks just pulled out entirely, but the company hasn't ever indicated that's really been an issue. And clearly we saw the backlog really above this point, not really dropping. So it'd be a little surprising to me if everybody all of a sudden in this quarter decided they were going to cancel. So that's kind of how I see it. One other thing I will note is that the shares outstanding have gone up and up and up over time, and you can see the past couple quarters that trend has continued. One note is that within the Q2, all the preferred shares got converted into Class A shares, and so that is one thing that also contributed to even more new shares being issued in the quarter. And again, this is my count of Class A shares, so technically a lot of those already existed in the form of preferred shares that just got converted in the quarter. But the company is still diluting and raising money by issuing shares through their at-the-market program. All right, let me go back and talk about their cash flows. And so this right here is just their cash flows every quarter. You can see 2024 Q2, all these are negative bars, right, because they are actually burning cash. And this isn't all of their cash changes, it's just the cash from operating activities, right? And so this does not capture, right? Let me be clear. This would not capture what they spend, the money to actually build new robots in the quarter, right? Because that money that they spend is counted under a different category. Those are considered investing activities, right? They're investing all the capital in those new robots. And so this chart here is showing their the cash that they bring in from their operating activities. And so this has been negative, again, because going back to what I said, all those fixed costs and just the general, negative gross margins on top of, all those additional operating expenses. And there is some stock-based compensation out of that, a couple of things. But in general, the majority of those are, we can treat them just as cash expenses here. And so you can see that their cash burn in terms of, or their cash used in operating activities did go, it was reduced in the quarter, right? The amount of cash that they used. It remains to be seen whether this is significant or not. If this trend continues, then that is a very good sign because that means that they're burning less cash. But it could just be an anomaly. This is choppy, so we're just gonna have to wait and see. Now, what I did and what I want to talk about here is I put together sort of a projection model. I started generally from, I have a similar chart, but I put in also their net cash used in investing activities, and so this is mainly comprised of what they spend to build new robots, all the money that they actually, it costs money to actually put those things together, all the materials and then the labor. And so this, they do report. And so what I did here for a model is I looked at how much they spend per quarter on those. And so these stack up down here as the blue and the red bars. And so you can see every quarter how much are they actually burning just from their operations, and how much are they burning because they're building new robots that will be put into operations, the next quarter, basically. That's the assumption that I'm putting here, that they go into operations the next quarter. And then I also have some of these yellow bars here for what are their debt payments. And these are debt payments that are due in the near term because of that additional $3 million of debt that I mentioned they took on in order to extinguish those warrants. So that is accounted for here. So you can see their overall cash burn to date, has been negative. And so I put together this model and I said, okay, a couple assumptions here. What if I assume whatever they spend to actually build new robots, if they're able to get a 50% annual ROI on that? And this is roughly what they have in their, target margins, their investor presentation. This is what they've said. They've proven out with some of their most profitable clients over time. The ones that have renewed for 5, 6, 7, 8 years. And they've been able to see some of these margins, some of the theoretical margins really proved out in practice. And if you also believe, that this is I would say the optimistic case for the company, if you believe that their version 5, K5, is going to be able to achieve those, roughly 50% gross margins over time, then this is a realistic model. And so this is what I put together to say, if the version 5, K5 works out, how might their financials, change over time? How might they improve? And so basically every quarter, if they just invest, $1 million, let's say, as I have it here in 2024 Q3, then over the next 4 quarters and beyond, but starting the next quarter, you get an annualized 50% return on that. So annualized, $500,000 in incremental gross profits from that $1 million investment into the robots. That's kind of how I'm modeling this. And so I also looked at a couple of things. I said, if they're able to do some additional restructurings or additional efficiency gains from the robots, right? And this is things like they were able to optimize how we're using the cellular data and save money that way. Or they're able to optimize by switching out their maintenance to a third party, because these are some of the things they've said they're going to do. We don't know the full impact of how much they're going to be, but if they're able to do some of these things and they're kind of one-off changes that are going to improve the results every quarter going forward, you're not going to see that amount of improvement every quarter, but you'll see that one-time improvement carry forward into every quarter. So if I looked at this and I was optimistic, say what they do in Q2 is going to have $500,000 worth of impact to the gross profits in Q3. Similarly, also investments that they do in Q3 and Q4 have that $500,000 worth of improvement, right? And so this is actually, I think, pretty optimistic, but it is possible. There's a lot of areas that maybe they could cut. Maybe they cut some, again, that cellular usage and some of their other processes. There's a lot of stuff that they can do there. So, and that's what they've been working on all of this year, right? That's been the major focus. So if they're able to do some of that, this would be, the net impact is basically a $1.5 million reduction over, these 3 quarters to their actual costs, whether it's operating expenses or their cost of service revenue, or even frankly their cost of product revenue, right? Because that does actually matter. All whatever warehouse space they have for the emergency communication devices, those savings are meaningful, or that they can be meaningful. And so hopefully that makes sense to you. If not, feel free to reach out to me or at a question in the comments below. So all that being said, I have this modeled out, and you can see that gets you to improvements in their net cash provided by operating activities. And I also looked at how much are they investing per quarter, and that this number, I figured about $1 million for the next couple of quarters. And I figure this actually grows, right? If the company is successful, they're able to get more contracts, fulfill more of some of that like master agreement they have with I think it's Penn Entertainment, if I recall correctly. They still have a lot of properties to roll these machines out to. They're able to get a couple more of those, some deals with the federal government that actually go through to scale up, with the VA. They're going to be spending more on these robots over time. So I figure this scales up throughout 2025, up to $1.5 million per quarter. 2026 goes to 1.75, and then ends 2026 and spans 2027 into $2 million per quarter in terms of cash spent on robots. And depending on how things go, these numbers could be way underestimating how much they're going to spend, in buying new robots if they get some massive orders and they're able to improve their manufacturing. But this is the model that I have right now. So again, trying to go with a hopefully realistic view of the growth for the company. Now, what happens along this is they're still burning cash, at least for operations, all the way through to the end of 2027, which is way, way, way off of, sort of the projections that management gave us roughly a year ago to try to get the cash flow break even by the end of this year of 2024, I think it was. But this is kind of how I see things potentially playing out. The implications to you as a shareholder are, the cash flows look like this every quarter. And, again, these bars are stacked. So where those bars end up, going down, that is actually how much cash they're burning. So in, Q3, they're going to burn about, negative $4.5 million. And then that will go, lessen and lessen and lessen until, they'll finally hit about $2.5 million burn in Q1 of 2027. And then that will actually quickly ramp up. And I actually took off the investments. Sorry, that is actually their total cash burn. And I went to Q4 in 2027. I took off the red bar for their actual cash used that they're actually investing in new robots, because I wanted to show that that's the point at which they're actually, basically cash flow positive just for their base operations. And any additional cash that they're using to spend on new robots is going to then fuel even further, cash flow for the business itself. And so they wouldn't be free cash flow positive at this point, but they would be, sort of at some definition of cash flow break even. I'm sure there's a particular financial term for this. As a non-professional, I'm not sure exactly what that is, but hopefully that makes sense to you. And so if I look at it this way, over all this time until they do get to this sort of kind of a cash flow break even point at the end of 2027, they're going to be raising, money via dilution every quarter between here and there. And so I put an assumption on the average share price that they're going to have to dilute at. I just honestly went at 20 cents in Q3 per share, and then upped it by 10 cents per share, assuming that the market starts to give them some recognition. And again, this could be, almost certainly is going to be wildly inaccurate. So who knows? But if I use those prices as averages here in terms of what they're able to dilute at, look at how much they actually have to raise here, I get to how many shares they need to actually issue per quarter. And I'm ignoring stock-based compensation here, so that's clearly an inaccuracy in this model, but it is actually counted on the, I guess it's not actually counted in net cash provided by operating activities. So sorry, that's just something that's not in here, but I think that's much smaller than the cash that they're going to be having to raise because of diluting to cover these shortfalls. So if I look at this, their shares outstanding, and this is ignoring any reverse split. that, by the way, did get approved, I think, or at least authorized for approval. And, it's, in my opinion, very likely to happen, because I don't think it's likely the stock is going to, quadruple in the next couple of weeks and stay there for 2 weeks, which is what is needed basically for the stock to stay listed without a reverse split. Maybe it'll happen. That would be great if the stock quadruples in a couple weeks, but I'm not really optimistic. I don't think these numbers really justified that kind of a run. We'll see. Who knows? But if I look at this, their shares outstanding would go up from roughly 150 million at the end of Q2 if you add in the Class Bs, all the way up to about 240 million shares outstanding by the end of 2027. So, about a 50% more in terms of share count between here and there. Now, what I also did is I put together just a very, very small, valuation, price to sales valuation in terms of, what I think their revenue by the end of this point would be about, what did I put? I think I have, which sells the revenue? Sorry, I'm trying to figure out my own model here. I put revenue. Yeah, ASR revenue is row 7 here. So the revenue, I assume, would be about quarterly, about $6.3 million by the end of 2027, which would get you to what's about $25 million in ASR revenue on an annual basis. And so if you look at that, multiply by for a price of sales, and then divide by that share count, I think by the end of 2027, this is, again, ignoring the split. So, if they do the reverse split, these numbers will change by a factor, but so will your share count and sort of the current market price. What won't change is this CAGR, if I did my math here correctly, is, if they get to this point, if they're able to survive and raise the way that I suggested, by the end of 2027, you could be looking at a stock price, if the price of sales is a 10, which I think if they were able to get this point, pretty conservative, maybe very conservative. We'll find out. You'd be looking at a stock price of, tad over $1 per share, which from today's price at, roughly 27 cents per share would be a 48% CAGR. I know that would be very, very disappointing to folks who have bought at, prices that are significantly higher than, $1 per share. But, if we look at it from today, that's what it could be. And, I think it's not unrealistic that we could see price of sales closer to 20 or even 30 if the company were at this point, if they had some, additional tailwinds behind them in terms of agreements and backlogs to deploy quite a few more robots. I think you could see share prices in the 2s or 3s at that point with a pretty, what do I say? I'm not going to say conservative, but a pretty realistic valuation model that you could see. If you're getting to that point, you're looking at a CAGR from today of, 100% year over year between now and the end of 2027. So that's kind of how I'm looking at the stock. So hopefully that gives you some insight and gives you an overview of their Q2, because that was everything I want to talk about today. So I haven't really seen any more comments. I don't know if there's anybody else on here. I know Transient Stacker was on here at some point. But I am going to hop off if there's nothing in the chat. I will give sort of one quick note about the channel very quickly. I think I'll get back to my Sunday afternoon streams probably after Labor Day on a fairly regular basis, probably most weeks. I know that I've been a bit hit or miss because life has been busy. Things here with my family and everything are busy in the summer, but I think once we get back to normal schedule post Labor Day, probably most Sundays here I will be able to stream in the rough afternoon time, Eastern U.S. time. Usually around 4 p.m. I would say Eastern U.S. time, somewhere in that vicinity. So, all right, I see nothing else in the chat, so I'm gonna hop off. Thank you everybody for watching. If you have questions or comments, feel free to reach out to me. I am on X or Twitter. I have it listed down there. It's just at Dustin Zollers. You can also email me. My email should be on the channel. You should go to the About page somewhere. You can find it there. Or you can add comments on the video here. So thank you very much for watching, and have a good one.